Welcome back to our lecture on Chapter 10, Stockholders' Equity. Now we're going to do the accounting for the issuance of stock. Let's assume that Home Depot needs to raise $100 million through the issuance of stock, and that had a par value equal to the issuance price of $10 per share. So this is pretty easy because what we paid and what we paid for it are the same, so the $10. So the entry for the 10 million shares, as you see here, we multiply times 10, and then we just have cash and common stock. Now, if it's above par, so in this case, we still have the same 100 million, but the common stock has a par value of 5 cents in this case, and we sold it for $10 per share. The cash stays the same, but now we have the 5 cents. So we take our 10,000 shares times 0.05, and then anything extra is additional paid-in capital. And you see that right here, our calculation here. And so because your debits need to equal your credits. And when you do that, here's how your stockholders' equity section of your balance sheet is going to look. So you see the 5 cents par, 10 billion shares are authorized, and 10 million were issued and outstanding. And these numbers are the same when there is no treasury stock. So these equal if there is no treasury stock. And remember, treasury stock is you purchasing back your own stocks. And then here's our additional paid-in capital in total paid-in capital, because we have our additional paid-in capital here to get our total stockholders' equity section. So now, no par common stock. So now if Apple had issued 939 million shares and there was no par, but they issued it for 16,422. So in millions, it's just a lot easier. You just have cash and common stock. They equal. There's no additional paid-in capital account because there is no par that was stated. And you'll see a similar, right? There's 1.8 trillion authorized, 939 are issued now and outstanding. Similar sections here that you saw previously. Now, if there is stock that is issued for assets, you're basically not including cash. So if we issued 15,000 shares of $1 par common stock for equipment that had a market value of 4,000 and a building with a market value of 120,000, you see that the market values go directly into our building. And then our common stock is the 15,000 times the 1. So then our additional paid-in capital is what makes our debits equal credit here. So make sure you note that you will record the building and the land and the market and the land as, the equipment and the building at market value. So now if you're also doing this for services, what we have is now we basically build the company, let's say $25,000 for legal services, and what we've agreed to accept is $2,500 $1 par. And basically the fair market value of the stock in this case is going to be $10 per share. So our entry would be we're incurring an expense of $25,000, our common stock stays the same at par, but then here we have our market value of the stock to get us our additional paid-in capital. And then preferred stock, very similar to common stock, you do have to have you normally would have separate accounts for paid-in capital in excess of par for preferred and common. And you do have two separate accounts, common and preferred stock accounts. So basically you have, and you can convert them, preferred stock to common. So here it's a convertible preferred stock of $1, 50,000, and it's issued at par. So it's easy, we just get cash of 50,000 and convertible preferred stock of 50,000. Now, if we are converting that preferred stock now to common stock and the rate of 6.21 to 1, our same 8,000 shares, but we issued in exchange 50,000 shares of preferred. So here's our 50,000 for preferred, and our common stock is the 8,000 times 1. So paid-in capital in excess of par would be the 42,000. So you need to understand these terms for your exam. Authorized is the maximum number of shares that a company can issue. This is usually a very large number, so you don't have to change your articles of incorporation or your corporate charter to issue more shares. Issued is basically what you've actually given to stockholders or they've purchased, and the number of shares that the stockholder owns in the actual hands of the stockholders is what we have for outstanding shares. So let's move on now to how treasury stock affects. So basically, you're reacquiring your own stock. And usually you may do that for any employee stock options because you want to buy low and sell high like we all do when it comes to stocks, correct? And then you want to possibly avoid a takeover from another company. So what you would have to do there, it is always recorded at cost, not the par value when it comes to treasury stock. And basically treasury stock is a debit balance. It is a contra equity account. And you see here, if we record 74 million shares at 4 billion, we're actually recording the 4 billion as our debit to treasury stock and our credit to cash. And how we record that on the balance sheet, as you can see here, is our 196 million shares, and here is our, and it's reduced, right? So it's a debit balance in our treasury stock account. So when you retire treasury stock, basically you just cancel the stock certificates. You just can't this stock won't be reissued. So if you want to once shares are repurchased, neither total assets nor total liabilities are affected, right? Because we're only dealing with the equity section. And we're only dealing no assets, no liabilities, just our owner's equity section is where our treasury stock will lie. And so if you resell, you basically increase your assets and your equity at that point. And so there's no gain or loss on the transaction because you can't make money on your own stock, but the amount received on the resale in excess of the original amount paid for the treasury stock is basically in a separate account called paid in capital from treasury stock translations. So let's actually work out an example to test your understanding. So if we are on July 22nd, 2014, we sold 1 million shares of treasury stock at $55 per share. Now, assuming that the average cost of the treasury stock is 54.05, what we would have to do to record this entry is we have the 55 million that we purchased, but now here we have the treasury stock, and then we have our paid in capital. And notice our treasury stock amount, the cost is basically our 1 million shares times the 54.05. So very similar to additional paid in capital as in preferred and common stock. So here we have at December 31st, this is what the company reported in equity. So, and here's the transaction it included: an issuance of 16 million shares of common stock at $10 per share, the purchase of 6 million shares of treasury stock for 100 million, and then we sold 3 million of that treasury stock. And notice we have a par value that is shown on the face of our financial statement as $1.50. So if we are looking to record the 16 million at $10 per share, we have the $1.50 here, and here's our 16 million at $10 per share. So additional paid in capital is our other entry, our other account that we have to record this entry in. Now, if we want to record the purchase of the 6 million shares of treasury stock for 100 million and the sale of the 3 million of the treasury stocks that were purchased, so in this case, we're going to do our treasury stock, and we're going to have 100 million, and then cash. That's quite easy. Then we're going to have our 70 million that we repurchased, and then we're going to credit our treasury stock for the 3 million at 16.67, and then the rest is our additional paid in capital. So you can also issue stock for employee compensation. This is very common in the C-suite, especially the CEO. So in this case, if you have 21 million new shares, and again, not treasury, in conjunction with your employee stock option, it would look something like this: your par value and then additional paid in capital for the compensation expense. And you would have, again, the treasury stock noted as a debit balance here. So we will stop right here and then pick up on our next lecture.